thank you all so much for making time to be here today. And before we get to the investment thesis, I thought it'd be really interesting to discuss what happened to cryptos doing away with the intermediaries dream. Is the fact that you guys are here means that it's over for sure? Sandy, can we kick off with you, please?
Oh, we're going to do away with plenty of intermediaries. It's just not the same intermediaries the crypto people think about. So yes, I think that this opens up a whole new range of peer-to-peer models, buy-side to buy-side models, institution-to-institution models, models that really aren't possible in today's capital markets world because of the way that the clearing systems are set up, because of the way that the settlement systems are set up, the need to have broker-dealers, the need to have that agency versus principal exposure. So, we are going to completely eliminate lots of intermediaries, but we are focused on a slightly different set of intermediaries.
You're staying. It's not you who's going to be done away with.
Definitely not.
Tom?
Yeah, I agree with Sandy, and you heard from one of the earlier panels how blockchains are creating efficiency in things like collateral movement and allowing us to provide more service to our clients at lower cost. I do think from an investor standpoint, I think it's a preferred habitat phenomena. I think there will always be people that are comfortable doing self-custody, participating in DeFi protocols themselves. But there are a lot of customers, existing investors. We represent on our retail side close to 18 million of them that want to work with a trusted provider, irrespective of whether they're buying an ETP or investing in crypto directly. And I think both models can coexist, and I think it's incumbent upon folks like Fidelity and the institutions represented on this stage and others to find ways that we can help unlock the value of this technology without completely co-opting it, I guess would be the word.
Thank you. Joseph?
Picking up on how we can help the adoption, I just want to start with disabusing this myth that we are centralizing crypto. In fact, 53 weeks ago, BlackRock managed 0 crypto. As of yesterday, we managed $61 billion of Bitcoin, ETH, and tokenized assets on behalf of clients. Most of these clients had no exposure to Bitcoin, ETH, or any tokenized asset before they bought their first ETP, and I'm pretty sure it's very similar.
Yeah.
We have, as of the last reporting cycle, 681 institutions have reported that they have ownership in our Bitcoin ETF. These are hedge funds, these are pension funds. Who would have thought a year ago that some of the largest financial institutions would be exposed to this? But I really just want to start with this idea. We are not centralizing, we are actually broadening exposure to new investors, and we do it on their behalf with a better vehicle than they had access to a year ago.
So this time a year ago at this conference, we were all here when the ETFs got approved, and that was a party. It's a shame you guys weren't here. So let's move on to how you view this space from a kind of investment thesis point of view, because as we sort of talked about when we were preparing for the session, you're putting wrappers around digital assets, putting traditional assets on digital sort of blockchain rails. So it feels like there are two sides to this. Who'd like to kick off? Tom, I'm looking at you. Maybe we'll...
Yeah, sure. I mean, we have interesting perspective because we've offered custody and trading solutions to institutions since 2018, and then most recently, alongside BlackRock and others, launched an ETP. It's kind of a long answer. I would say when we talk about institutions, we got to be really clear about which types we're talking about. I think in the early days of our evolution, our customers were family offices and hedge funds. Largely attracted to the space. They saw Bitcoin in particular, and then Ethereum and others as speculative assets, network effect opportunities, and in the case of Bitcoin, very deterministic supply. So basically just a really good trade with some long-term upside. I think that if we start thinking about more traditional institutions, we service a large number of RIAs at Fidelity. We also have a large asset management business. That's where it starts to get a bit spottier. I think most recently, these investors have looked at the space maybe from two perspectives. One, again, specifically around Bitcoin as a store of value, something that theoretically hedges against monetary inflation or can diversify traditional portfolios. I would say that those investors are, it's a very small group, but I think word is getting out and there's more of that type of thinking. And we've published some research on, what are some interesting ways to think about allocations in a traditional portfolio? I think when we look at the broader space, the thing that, this is my personal interpretation, it could be those things. But I also think we're seeing a pretty significant wave of technology akin to the internet or what we saw with mobile. And my guess is that over time, we'll see folks that have more of a tech investing bent manage a public tech portfolio, even given some of the themes we've talked about here, whether it's AI or the impact on energy markets, that will necessarily need to look at these assets and say, how do I actually get exposure to those? Even though it's very different and sort of the organizational model for generating returns and economic value is very different than investing in a company. But I tend to think, said another way, there's probably something in here for everyone. And depending on who you are and your risk tolerance, you would look at it in different ways.
Sandy?
Yeah, so we also see two sides to it, right? From the traditional asset side, what we really focus upon is there are so many efficiencies to be gained by adopting these technologies, right? The current way that we settle transactions, particularly for public securities, was designed over 50 years ago, right? And we really have not updated the system since then.
We moved to T+1. Come
Oh,
on.
yes, well.
Come on.
We designed the current system because the volumes and the velocity of trading had become overwhelming, and the industry could no longer settle one trade at a time. So they've come up with this convoluted method that has really influenced the industry for the past 50 years. And what we are now seeing is the technology has caught up, and we can actually go back to trading one trade at a time and settling it almost instantaneously, and doing that in a manner that is going to allow the velocity and the volumes to grow. It's almost like the trading equivalent of big data. It's big trading. All right, so we think that there's huge opportunities there, and we do believe that that will unlock in terms of traditional assets moving on to blockchain technologies and the innovations from the crypto ecosystem really transforming how we operate on the traditional side. But we are also having a very unique view because we have deployed our own technologies that we're building in crypto now across 8 different chains, and we're running node operations on 12 different chains. And so we operate also as very much a digital native. And we have really come to understand the value in the ecosystem, right? The speed of development, the interoperability, the ability to structure trades in all new ways that were impossible even just a year or two ago. So we believe very strongly that there is so much value to unlock in these protocols and in these new altcoins that are coming to market. And we believe that this is going to be, as people become more and more comfortable with it, with a good regulatory framework, this is going to be an opportunity on par with AI. So we really kind of see both sets of opportunities and are looking to really build across both areas.
Joseph, before we come to you, did you say altcoins? Does that mean meme coins?
Yes, well, we actually have published research, and we have a whole theory that meme coins actually reflect a new style of investing from younger investors that want to trade fast-moving, viral trends, and that there's a whole set of crowd factors that we've identified that help drive value around those meme coins. So yeah, we trade meme coins as well.
Love it. Joseph, can we come to you, please?
So we get the question all the time, why is BlackRock going into Bitcoin investing on behalf of clients? And I think it's just a very simple thesis. We're a fiduciary. Our goal is to help more and more people experience financial wellness. It would be irresponsible to ignore the best performing asset since it was born on January 3rd, 2009.
Yep.
How can we not, if we're in the business of giving clients
FT,
choice,
Financial Times.
yeah, we are in the business
They
of
hate
giving
us.
clients choice to help them build better portfolios. How can you ignore that? Now, our role then is to do it in the way that's most safe and easy to access for our clients at a low fee. And I think what we're most proud of is not how much the assets we've gathered, but that we satisfied a client demand. Mm-hmm. We did not create demand. There's $100 billion representing end investors who had no access and sometimes no interest. With that fiduciary mindset comes a huge responsibility. We are not throwing this out there hoping it sticks to a wall. We have a responsibility when you're offering these products to educate, educate, educate. That's end investors, it's financial advisors, it's their older head office, it's pension funds. And Bitcoin took us years to explain, Ethereum longer, but I think people are understanding there's a role in a well-diversified portfolio. In December, we published, not saying a recommendation, but a statement that we believe a well-diversified portfolio should hold 1% to 2% of Bitcoin. And we took a lot of heat for that. Why not 50%? Well, why not 50% is if it goes bad, people don't retire with dignity. But this is a first step, and we're actually quite enthusiastic for trusted brands to be the ones offering this. And we're not centralizing it. We're not forking the portfolio. No one needs to freak out. This is on behalf of clients, and we give our clients choice.
So let's just, before we move on, if I may ask about the diversification argument, because at the moment, I think it's a 2-year high, the correlation between Bitcoin and NASDAQ 100, that doesn't feel very diversification-y to me.
Can I take that one? When you look at correlations, we always fall into the trap of checking our phones yesterday, and we really don't like the view that this is a risk-on asset. It's a risky asset, it's volatile, but if you look over the long term, the clear correlation is that it's inversely correlated to real rates. Yes, at moments of time, it trades like the NASDAQ, but our clients are not speculators and they're not traders. So you need to look at the long horizon, which to me, the biggest risk to Bitcoin today is not the regulators, it's actually the macroeconomic environment. Are we going to have inflation from tariffs? Are we going to have dislocation of supply chains? Are we going to have labor markets dislocated by less immigration? And are we going to detach from some of our largest trading partners? Those are high-risk situations when rates go up. In 2022, when rates went up, Bitcoin declined 67%. So we are less worried about the day-to-day correlation. We're worried about the long term because that's what investors are interested in.
Yeah, and maybe picking up on that, we've done a lot of work in this space. And I just seen some data that our research team published that over the past roughly 3 years, if you smooth out, to Jessop's point, you're not looking at the day-to-day movements. Bitcoin as a proxy for the space has been, the correlation with the S&P has been about 0.5. When you go further down the tail through other types of assets, when you get to fixed income, to Jessop's point, there's almost no correlation. And ironically, you get to gold and commodities, it's even weaker. So when you've got an asset class with a positive expected return and certain fundamental principles that would suggest, Bitcoin, again, supply and demand, that, more demand begets higher price, plus the diversification aspect over longer periods of time, it is something that folks need to look at. Now, the question for a lot of institutions, if it's not an existing asset in their, whatever their benchmark is, that then for certain investors, it starts to become a bit of a challenge as to how they do that.
Do you expect that to change?
I would hope it would change. I mean, to Jessop's point, best performing asset over several time periods going back almost to the inception of Bitcoin. And then the availability of instruments like the ETPs and just broader access, more liquidity, and certainly the increasing market cap of the overall cryptosphere, which, remember, is slightly above, someone said this earlier, the market cap of NVIDIA, right? So even from an attention standpoint or ability to get large positions on, it's still tiny.
And Sandy, do you think that this argument around diversification, will it hold even if companies go and put Bitcoin on their balance sheet like MicroStrategy? Will there be any impact from adoption?
Yeah. Well, first off, in terms of correlations, we have seen several incidences in the last 5 years where there has been abnormal correlations between assets that typically don't correlate. So that was especially the case with equities and bonds in 2020, right?
Very true.
Very true. We actually have shown in our research that the correlations that Bitcoin has to other asset classes tend to change, which is a very unusual trait for an asset class, right? It's one that kind of causes a lot of our quant teams to scratch their head because these relationships aren't supposed to change. They're supposed to have some steady principles. And I think that this is why it is not going to matter that these companies hold Bitcoin on their balance sheets and things, because to the macroeconomic landscape that Jessop laid out, there is a huge risk of governments not willing to work with other governments, right? This is a risk that we have really not seen in our lifetimes to the extent we might see in the coming years. We really might see the world begin to break up into geopolitical blocs that don't want to deal with each other. Yet all these companies are global. We run global businesses as asset managers. How do you operate? And so I think that Bitcoin starts to play a very important role of being one of the only means of exchange that might still work to allow global operations to flow. So I think that there is a real, we've seen the argument about what Bitcoin is continue to expand and evolve, and I think that there's more to go on that trajectory.
So do you think that Bitcoin could replace the dollar as the global reserve currency?
I think we're probably still many years away from that, but I would say that Bitcoin could become an emergency currency that people will keep reserves of to help make sure that they can handle all of the trade operations they need to handle during periods of high political consequence.
Any thoughts on this idea of reserves, Bitcoin being in central bank currency reserves?
Yeah, I mean, I agree with Sandy. I mean, I think I can't project forward far enough to see Bitcoin displacing the US dollar. But, look, there's been talk about Bitcoin being added to central bank balance sheets and, someday part of the SDR for, 5-10 years.
Unbelievable things, right? What
Yeah,
times?
but what are we seeing now? You've got multiple states in the U.S. looking to create Bitcoin reserves. The incoming president is talking about it. Several other sovereigns have either done it or are talking about it. So it's not beyond the realm of possibility.
Joseph, do you have any thoughts on that?
I don't have a strongly held opinion.
Okay, let's move on to how investors will access or get exposure to digital assets. One of the things that sort of came up during earlier conversations today was that people or professional institutional investors want to access the space like the way they're used to accessing other asset classes. They want it to feel the same, look the same, fit into their processes and procedures. What does that mean from your perspective, from an investment perspective? Will you just get bigger and bigger as you guys are already the trusted way to access other asset classes?
I think for the next couple of years, you'll see the ETP as a wrapper, so a traditional technology wrapping these crypto assets. But I think we're going to be on a journey of understanding and adoption. And when adoption is so widespread, where almost every American, European has some exposure to crypto assets, the word self-custody will be less of a dirty word. I, at BlackRock, don't believe that we're going to move away from traditional custodians for a long time, but their role may change. The technology they use may change. In the old days, you trusted the oldest bank because they were a trust bank. Just think about that. We trusted them because I trust data and software and technology more, and I trust smart contracts. I do think in the short term, it still will be wrapped in these traditional wrappers. I think in the long term, as people hold more digital assets, it may not be at all an ETP wrapper as you move away from early adoption. And that's okay. We don't want to be the biggest. We want to offer choice to our clients.
Yeah, I would say that one of the most overlooked and most important pieces of the success of the ETF products this past year has been that we, as traditional firms, are all now using digitally native service providers in our day-to-day operations. We are holding wallets and using those wallets as part of our day-to-day operations. And this is, I mean, for the crypto natives, this probably sounds crazy, but for those of us in the traditional industry, our entire industry is built around accounts. And accounts are things that we can only aggregate virtually, right? So an investment portfolio, actually the assets in an investment portfolio don't sit together ever in terms of when we think about our total portfolio of holdings. But we are now moving to a wallet-based system, and that transition is going to take time because the entire traditional financial industry has been built around this concept of accounts, and we need to introduce wallets and get people comfortable with wallets and move things to wallets. But the benefits to be had once we see those assets in wallets and we can commingle and start to see these assets truly become interoperable will be so huge that we will take that journey and we will re-engineer all of the processes, but it will take time. But we started the journey in 2024. I mean, this 2024 will be remembered as the really the pivot year that we've started to see the prospects for what the financial infrastructure looks like change.
And I would just add, what I said earlier, I think we'll end up with a mix of products, hybrid market structures. I think for most traditional investors, the ETP is a really good way to get exposure. It can be managed through existing service providers and existing accounts with very known processes around custody, settlement, et cetera. Since we've been doing the institutional business now, which again, since 2018, we've been doing an annual survey of institutions. And in the early years, one of the bigger issues they had was the operational infrastructure to forget self-custody. Many of them can't self-custody, even understanding what third-party custody would look like. What are the safeguards? How is transfer of assets managed? How do you segregate duties at the client to make sure that no one person can move the assets? And that was a big stumbling block. Many of them are now past that. In subsequent surveys, that's become less of an issue. But I think for a lot of investors, being able to we see this on the retail side of our business. We have lots of customers that buy crypto directly, but a larger number, eventually, that are just happy to place a trade the same way they place a trade for another ETP. So I think that is where we'll end up.
Any thoughts, Joseph?
Yeah, I'm a futurist and I'm an optimist, and I think this is the entry-level drug and the first test case for completely digitizing our ecosystems. Sandy told you that all our infrastructure has been built over decades and decades and decades, and it's creaky. We have a view that the internet went through phases. We believe blockchains are going through phases, and I'm going to be a little bit excitable here. It's possible as we think about these chains that gaming and NFTs and meme coins are practice for massive adoption of not just financial services transactions, like billions and trillions of them, but usage in the real human economy. Like actually your day-to-day, you're interacting with payments in a digitally native manner. And maybe these first few phases are testing and challenging the chains to be able to handle the volumes that are coming. I'm not prophesizing what's going to happen and it's going to be hard. I think this is going to be more transformational on financial services and people's lives than the electronification of the equity markets, the electronification of the bond markets. Those took decades. This has an ability to massively accelerate transformation, and that's the beauty of the technology. Do I know if it's next year or 10 years? I don't know. But shame on all of us if we don't stop doing proof of concepts and experimentation. It is not innovation until it's put into production. So if I have an ask of myself and others, stop playing around with projects. There's so much talent in this space. Start changing and hacking the ecosystem, because I think that will be the real use case for a lot of this technology, well beyond just investing in Bitcoin, ETH, and others.
And
I'll be a little bit controversial here, if that's okay.
And not just payments, right? Because if you think about it, my investment portfolio today, what does it do for me day to day? It really does nothing for me, right? My whole point of having it is so that when I retire, I can actually live well, right? But we can use these new programmable tokens to change that whole dynamic, right? So here's a perfect example. The Ford Motor Company, if you own 100 shares of Ford Motor Company, you qualify for their friends and family discount. How many people own Ford Motor Company in the mutual funds that they have, yet they have no ability to even know that they own this, much less access that benefit, right? And so what I think these programmable tokens are going to also do is unlock this concept of benefits of ownership. Benefits of ownership in the securities that you have, benefit of ownership in the bonds and in the private assets you have. And we are going to have a whole new ecosystem where that investment portfolio helps me live a better life day to day, because it is all being used between AI and blockchain and programmable tokens. This is all being delivered to me as I need it, where I need it. So if I walk in to look at Ford cars, that little notification that I'm entitled to that discount is going to pop up on my phone, and I'm not going to have to go looking for that, right? And I think that changes the whole foundational concept of my relationship with my investment portfolio.
Before we move on, have you guys read that Goldman's is spinning off their crypto platform?
Yeah, I heard. I didn't know it was official. I heard noise that it might be happening.
Yeah, that's going to be interesting. I don't know if anyone is interested in it, or if anyone wants to talk about it, but maybe not. Okay, let's move on.
No, what I would say is, as I understand it, they've built capabilities to tokenize assets, and so I think coming from that world, traditional market structure. In some of these cases, you need folks that have the existing liquidity, the existing businesses to support the new protocol, right? Because it's a little bit of a network effect on a minor scale. You need folks that do the business currently to migrate the business to a new medium. And I know the RWA panel, the tokenization panel, talked a little bit about that. And I think it's challenging if you're a big financial institution to say, come play in my sandbox. It's more like, let's create an industry sandbox.
Well, and to that point, what must Goldman think about the future of investment banking if they don't think that it's critical that they own their own tokenization infrastructure?
We should really ask them. I think I might go give them a call and ask them. So tokenization, before, let's talk a little bit about that in the sense of collateral. So tokenized money market funds, traditional assets on chain. How do you see that world evolving? And stable coins, maybe we could briefly touch on that.
I just need to make a full disclosure. We're an equity investor in Circle. We are the manager of their $40 billion reserve. Have to say that. When we entered the tokenization space, we tokenized a really boring short-term treasury fund, as traditional as you get, trades Monday through Friday. We did it for a reason, and we wrapped it in a crypto wrapper. So super traditional, wrapped in a crypto wrapper on public Ethereum, because we wanted to send a message that interoperability and permissionless is going to be the future. So that's number one. Two, it wasn't a project. We needed to find real-world utility for tokenization. You can tokenize your chair, your pen, your alts. It's super easy, and it provides no utility. In this case, we wanted to provide market participants who are holding stablecoins and earning zero yield in a 4.5% yield environment, who needed to stay on chain, couldn't wait till Monday morning to get their stablecoins back, and they could 24/7 hold stablecoins or hold a yield-bearing instrument that is redeemable instantly, and that is utility. And the reason why we did that is these projects that go nowhere are harming us. Now, that, even though it's one of the largest tokenized funds in the world, and Sandy and Franklin Templeton were the leaders here. We're following you. I want to be absolutely clear.
Well, we follow you on plenty of things, don't worry.
It's still not a success until this provides more utility. Let it run through financial transactions. Let it be lent. Let it be borrowed. Let it be used in collateral transactions. It needs velocity. And once that happens, you're going to start unlocking and showing people the benefits of tokenization because it has real-world utility, and it reduces risk for investors, and regulators should understand that. But it needs to start with utility as opposed to press releases.
Couldn't have said it better. I do think this is going to be, if you think of stablecoins as the first killer app, this interconnectivity and this instant redeemability between stablecoins and tokenized money market funds is going to be the next killer app. And that is really going to unlock use cases in areas that no one would expect, right? I mean, we're getting requests from companies that have never spoken to an asset manager in our lives other than about their investor relations, coming to us with use cases that they're like, could you make this work for us? And so it's so exciting because the utility that Joseph mentions is going to rapidly expand beyond the crypto ecosystem. And that was what allowed stablecoins to become so popular, is that their usability and their utility expanded beyond the crypto ecosystem. And this is why these new interoperable facilities are going to really become, I think, the next killer app for the ecosystem.
Yeah, I mean, I agree with both of my fellow panelists. I would say I remember when I first got involved in the space, and the penny dropped first about Bitcoin from more of a macro standpoint, and then I started understanding the technology. Working at a bank, I said, boy, there's a lot we can do here to make existing things more efficient and bring some sort of order standards to asset classes that don't have a DTCC or no central mechanism for transacting or clearing. And I think what's interesting is, as the earlier panel showed, we've made really good progress in terms of how does the industry use this as a technology that can extract cost out of the system. But remember, in the early days, we also talked about things like the democratization of finance. How do you take, whether it's native crypto assets with unique return profiles or even traditional assets that most investors cannot access, how do we do that? And I think for me, as part of an organization that serves lots of retail investors, I'm hoping we see the progression where the technology can actually unlock, to Joseph's earlier point, access to products that have the net effect of improving their financial lives and ensuring that they can meet their objectives over what will be an increasingly long lifetime for most individuals. And so for me, I just hope we get to the point where we start to see that and we move out of the realm of it being a way that we can take cost out of the business, which I think is a necessary first step, right? Because we have to move deliberately and understand what the technology can do, and then the question is, where else do we apply it? And I think, the regulatory unlock and a better reg environment in the US, as well as Europe and other jurisdictions, I think will be an accelerant to that type of transition.
What do you guys think about the companies that are in the space today, the kind of crypto-native companies, this whole idea, that tokenomics, raising capital via tokens, is that something that's here to stay, that's viable in the long run?
Can I answer the question slightly differently?
Please do.
I don't have the greatest opinion on tokenomics. I think we have a marketing and a language problem. And you have these crypto-native companies, you have these traditional companies, and everything is called crypto. A wallet is crypto, an identity is crypto, an asset is crypto. Like, at a certain point, we're going to have a better relationship with our global regulators if we talk about this as digital innovation. What country doesn't want to lead in digital innovation? I've got a digital identity. I've got a digital wallet. It's not crypto when you tokenize a money market fund. It's a digital representation of ownership. So I know I didn't answer your question, but it's like a public service announcement. Everyone has to do a better job choosing better language. And then we have a huge responsibility to educate, but side by side with the crypto natives and the Ethereum Foundation. And we have to do a better job, because if you think this is confusing to regulators, tokenomics,
Yeah, no doubt.
What is that?
Yeah.
So I didn't answer your question. I'll leave it to my
fine.
colleagues,
Yeah.
but I think there's a real language and marketing and education problem in this space, and we have responsibilities to do that.
I would just say, I completely agree. I would also say, be careful what you wish for, because, having delved deeply into understanding tokenomics, I can tell you that there's a lot of very, very inadequate tokenomic schemes out there. And if we really do start to see widespread adoption of tokenomics, there will be lots of regulation around how you have to manage token pools that will be very uncomfortable for many of the protocols that have their token pools today. So I do think it's here to stay. I would just be a little careful about pushing too hard to say that it's unique.
So thank you so much. This is talking of language. To remind you where we are at a crypto conference. When Sol ETF?
What's Sol? Kidding.
Some sun or something, I don't know. But without the H. I mean, people, come on.
Well, I will say this, right? We, as professional asset managers, have already talked a lot about diversification here. Today, in traditional portfolios, you rarely see single asset ETFs survive for long. I think we will see more single asset ETFs in those assets that can act like a commodity. But I think as you get into the different categories of ETFs, you're going to go quickly to multi-coin ETFs. And I think that, launching the right suite to get to that point is going to be very critical. And I think you will see thoughtful expansion of the ETF suites from all these firms over time.
And I would just say, I think under various regulatory structures currently, I think there's still a question about what's a commodity and what's a security. I think until that's cleared up,
Joseph,
unclear.
Would you like to put the H into when?
I want to thank the CFC for including me at this conference. I am not going to comment on individual asset classes. We all have a pretty good track record, 30, 40, 50 years of understanding when there's a demand for an asset, and when the technical capabilities are there, then create a product. We're really commercially minded people. I'm not going to comment on any single token, but we're really good at figuring this out. It does start with client demand. It starts with education and understanding. People took a long time to understand Bitcoin and then Ethereum. All these things will end up in people's portfolios, but I won't comment on an individual one.
That's fine. We have 20 seconds, so if I could just come down from you, Sandy, down the line. What's your sort of top wish for the next 12 months from the crypto industry?
Jessop had hit it on the nail. I would like clarity on what is a security and what is a commodity, and I would like the regulators to start to re-examine the need for there to be KYC AML at a client level and think about this at a transaction level and allow for shared KYC AML.
Like that list?
I agree. The one thing I would add is there's going to be a process where in the U.S., we have to pass laws and then rules are written. After Dodd-Frank, this took over 10 years. It better not take that long this time around, and so I'm hoping we can do it quickly. And if we can get some guidance for safe harbor, vote of good faith that in certain cases we can move in that direction before the rules are fully written, that would be maybe nirvana, but I think would be incredibly helpful.
Joseph?
I would love two things that are good for investors. The SEC to allow ETH staking in products. I think it's a better return for customers, and we can prove we can do it responsibly. And the second thing, this is highly technical, is the ETFs are only allowed to have subscriptions and redemptions in cash format. We think in kind is a better answer, and it will shave basis points of cost off investors. And
100%.
both of those are things that our regulators should understand are part of their mandates. Do better things for investors. I think we'll have a different stance, and I'm very confident that'll happen this year.
And the regulators should start running nodes on every chain, right? They should start understanding that they can regulate in real time.
That would be nice. That was the whole idea behind, collecting all that data, right? Which is now just sitting on some server somewhere and no one ever looks at. I'm so sad that I have to let you go, but we have to because this is Switzerland and we'll be, upsetting the national psyche. So please join me in thanking the panel. Thank you.
Thank you. Really well done.
So much fun.